What's up, everybody? It's the Gore Report checking in with an earnings report. So on Wednesday, Marvell Technology dropped its earnings, and the numbers tell a story worth paying attention to. But more than the numbers, it's the direction that matters. So let me give you a rundown about my history with Marvell Technology. I've owned the stock since 2021. So I've watched it go from 50. I watched it go up to $90. Then I watched it go down to $37 during 2022. Then I saw a rebound and go to $127 at the beginning of last year. And then I got a chance to see it go down to below $50 3 months later in May of last year. And now we've gotten to the point where it's over $200 and it's realizing its full potential. So as a shareholder, I'm very happy to see that it's progressing and moving in the right direction. So now let's just look at the numbers that Marvell reported. The company posted a record Q1 revenue of $2.4 billion, which is up 28% year over year. The data center segment, which is the engine of their super cycle, grew 27%. Now, this is not a company that is struggling. Their AI-related bookings are exceptional and it's growing. Marvell beat on Q2 guidance. The full year fiscal year 27 revenue now is expected to approach $11 billion. This company is now hitting all cylinders, and it's finally getting its footing in place in the semiconductor space. Now, with the earnings call, Matt Murphy said on the call, the key thing for right now is the revenue growth will continue accelerating each quarter throughout the fiscal year 2027, and this is powered by the data center demand. Data center is really, really key right now. For right now, the confirmed data center revenue is expected to grow approximately 40% this fiscal year and close to approximately 50% in fiscal year 2028. Now, the key here, a big part of why Marvell has really taken off was the Nvidia $2 billion investment in Marvell, which is a major validation from the biggest name in the AI chip space. So just think about it. Marvell is supposedly a light competitor of Nvidia, and Nvidia decided to, pretty much invest $2 billion into Marvell. So that tells you that Nvidia looks at Marvell as a competitor because they're dealing with the in-house chip space and they're servicing Amazon, they're servicing Microsoft, whereas Nvidia is dealing with GPUs. So this is how Nvidia is going to look about growing their business, is to take key equity stakes in some of these other companies. So right now in the XPU spaces, Marvell and Broadcom. Right now, Marvell and Broadcom together, they control roughly 95% of the custom chip market. And that's what we would call a duopoly. Broadcom holds about 70% of the market share, and they deal with Google, Meta, OpenAI, and Apple. They have those guys as clients. Whereas Marvell is a smaller player, but they're moving fast, and they're getting institutional investors' attention for the most part. So Marvell designs chips, in-house chips with Amazon, the Trainium, which I've spoken about plenty of times, and also Microsoft, their Maya chips. Now, custom AI chips, ASICs, which Marvell and Broadcom deal with, are projected to grow about 45% in 2026. That's nearly 3 times the 16% expected growth in GPUs. That's why Nvidia is taking a stake in Marvell, because there's growth in the ASICs business. So it's 2 key chip businesses. It's ASICs, smaller, cheaper, but not as powerful as the GPUs, but now companies are wanting to build their own chips in-house, and it's cheaper for them. So to close, Marvell had a more than strong Q1 report, but the more important key takeaway that I want you guys to understand is the gravity in semiconductors is shifting. The GPU space are pretty much giving way to the purpose-built chips, which are the XPU chips, the ASICs chips. And companies enabling that transition like Marvell and Broadcom are no longer flying under the radar. Everyone knows about them. So this is the Gore Report checking out. I'll get with you guys later.